So Jason, from a financial standpoint, I think everybody at this point knows and understands that one really easy way to help your finances is to be healthy and to take care of yourself. And so Jason, you're the financial guru. So what are some ways on that side of things that you can help protect yourself financially when health crises or health problems start to arise?
Yeah, let's talk about how, like, I'm a big fan of saving people money on taxes and also helping them build wealth. So let me talk about like one way that they can do that now, and then also what to be thinking about as they're turning 60, 65, 70 when it comes to planning for, financially the health aspects of it. Is that cool?
Perfect. Yeah.
Okay. So something I want you to look into if you're watching this is if you have a high deductible health plan, ADHP, high deductible health plan. And if you do with your insurance, you have the ability to put money away in what's called a health savings account, okay? An HSA. Some people might have a flexible savings account, or there's another health one, but those aren't quite as good. The health savings account is the best one. And if you have one of those, if you're single, you could put up to about $3,300 per year in one of these accounts. And if you have a family, if you're married, it's about 67 and change, maybe 6730, 6750 right now. So the benefit to that is you put money in now and it's tax deferred, which means you lower your taxable income for this year. So let's say you put in $6,000 and let's say you're in the new 22% tax bracket, right? Just right off the top, you're going to save about $1,500 in taxes right there, right? Just from that. Okay. So the benefit to that is if you have health expenses, or you want to invest in like some sort of health program, if you do qualify, if you are technically like medically, obese, or you have diabetes, things like that, you can use this money. And so you put the money in tax deferred, right? So you don't pay taxes today. You can take the money out at any time for anything that is a qualified medical expense, completely tax-free. Okay,
right. And then also, to add to that, I've had clients who have used my program who have been clinically overweight or obese, have actually written my program off against their taxes as a medical expense as well. So, getting healthy, there's definitely incentives out there, financially speaking, to get healthy and to get the help to do it. So, yeah.
And they changed the rules. So you can no longer do over-the-counter medicines. So any sort of self-diagnosis people are doing is not going to be covered anymore, right? So it has to be real medical conditions. So you can put the money in there tax deferred. So that's one tax advantage. You can use the money tax-free for any medical expenses, either now or later in retirement. And then you can actually invest that account very similar to an IRA. So people are familiar with IRAs. Most people are Roth IRAs or traditional IRAs. You can invest the money the same way, and you can use it the same way as an IRA after you're 59 and a half. So, you can take the money out. Again, you can invest it for the long term if you want, keep it in there. So it's another way to defer more income now, while maybe your tax bracket is higher. For about, over half of people, maybe 70, 80% of people, their tax bracket is going to be lower after they leave work. So it's a great thing to do to get some money in there, tax deferred. And if you have medical expenses along the way and you have money, you have extra cash flow, you can still put the money in there, pay the taxes now out of pocket, save your receipts, right? So say you're 50 years old and you have maybe 15 years, 20 years to retirement. If you save all your receipts, it's so important. You have to save your receipts. Okay, I'm going to say that again. Save your receipts. If you save those,
got it.
And you let that money and you put that money there and you invest it for, say, the next 20 years, and it might double, or triple in that point, the money you put in there over that time. You can take the money out later and reimburse yourself with 100% zero tax out of the gain, out of the money you put away. And so you can really do some really good things for yourself if you can get your money in there. The biggest challenge for a lot of people is actually like understanding their cash flow well enough to make sure that they are, managing it on a month-to-month basis, which is something I help out with, right? To make sure that you're planning for these things, but that you can put that in there. So there's multiple ways to do it that if you had, like you said, say for, your program or whatnot, if you can put money in there and then you can immediately take it out if you want and use that. So that saves you a huge chunk on, really taxes right there. And so your net cost is going to be a lot lower. Or later on down the road, if they need it for health expenses. Essentially, it's, you know, money that never gets taxed. So it's called triple tax advantage account. So really, really useful account for health.
So an HSA is a triple tax advantage account.
Yes.
And what people can do is put money in there up to a certain amount every year and have that money on the and they can actually invest it so it can grow and they can make
Correct.
money off of this account. And then, for example, let's just say if someone were to, you know, invest and work with me to get to a healthy weight and start to get their health back and get off prescriptions and reverse some chronic conditions and these kinds of things, not only can they take that money out tax-free and use that money to invest in a program like mine, then they can also then turn around and deduct that investment against their taxes as a medical expense at the end of the year as well, potentially.
Yeah, so the medical expense has to be over like 10%, depending how old they are. Right? You know, if they're over, I think 65 or 66, it's like 7.5, but it has to be that percentage, 10% of their growth of their you know, AGI, adjusted gross income. So you know, you want to make sure that you're following those guidelines, and then you also want to make sure that, you know, it's a qualified medical expense, right? Because you don't want to use it and find out later that it wasn't. So it's really important just to double check that. But if you, like you said, you had a case that a client was probably working with a doctor and it was 100% qualified for them to do that. But I have to always, you know, as a financial planner, I have to always make sure people are doing things the right way, because, you know, the penalties for not doing it right are so important, which is why I get paid to help people to make sure that they are doing things the right way. So really,
and always make sure to defer to either someone like Jason or your tax professional when you're looking at doing these kinds of things, guys. So